Good morning, good afternoon, and good evening, everyone, and welcome to our 2024 ESG Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit that's building a better path for entrepreneurs worldwide by improving inclusion, access, and knowledge in entrepreneurship. As you're going to see in the chat in just a moment, the Nasdaq Center provides programs, resources, and exceptional mentorship to entrepreneurs across all races, industries, and geographies. So check out those links and resources in the chat. Now, I've got a couple of housekeeping items before we get started. Firstly, let us know where you're dialing in from in the chat. See if you have a neighbor. Secondly, we're going to open up for live Q&A near the end of each panel. Also, let us know those questions in the Q&A function at the bottom of your screen throughout each presentation. We'll try our best to get to them all. Now, none of what we do here at the center would be possible without all of the amazing support from our sponsors, including Nasdaq, Lehigh University, BMO, Airbnb, KPMG, Wilson Sonsini, BPM, Google Cloud, and HubSpot for Startups. We're humbled by their contributions and hope you're grateful too. Okay, before we get started with our content for the day, I'm going to launch a few polls just to take a step back and see how everyone's doing. The first poll, how are you feeling about your business right now? Are you optimistic? A little survival mode? Let us know. We use this information to fuel the additional wellness resources we provide for you, the entrepreneurs out there in our ecosystem. All righty, I'm gonna let this roll. Thank you for voting. And let's see, New York City, Atlanta, welcome. Oregon, Dallas, Texas, San Diego, California, London. Wow, big mix. Boise, Idaho, great. Bay Area, Los Angeles, St. Louis. Welcome, welcome, everyone. DC, awesome. Austin, Texas, welcome. San Diego, Estonia, great. All right, well, I'm going to end this poll, share those results. Looks like optimism is in the lead, so that's good news. But understand there's a little bit of survival mode and anxiety out there, so we'll do our best to get back to the drawing board on helping with that. So the next poll I'm going to launch is what's keeping you up at night. We use this data to understand what we should be putting in our goalpost for the next couple of months of programming. All righty. So Nigeria, welcome. Got a good mix. Tampa, Florida, Denver. Welcome, welcome, everyone. Oh, this is interesting. The poll is pretty mixed, but I'm going to end it and share those results with you all so you can see it. Looks like sales is in the lead, followed by finance, scale, but a good mix. So thank you all for sharing that. Appreciate you. All right, now on for the agenda for the day. We're going to kick off our program with a fireside chat on VC perspectives on diversity and ESG confusion, and then transition to our first panel, how ESG can create a competitive advantage for early to mid-stage entrepreneurs. We're then going to have a quick break followed by our final panel, how later stage winners are looking at ESG and pre-IPO ESG implications. Note the same Zoom link will be used for each session so you can join in for each panel whenever you'd like. So without any further delay, please join me in welcoming our first guests. We've got our moderator, Amanda Urquiza, who's a partner at Wilson Sonsini, and Johannes Leonard, who's a co-director of Venture ESG. Looking forward to this conversation. Amanda, Johannes, over to you.
Thank you, Colin, and thank you, Nasdaq, for having us here today. Johannes, let's dig right in. In the wake of Fearless Fund and Hello Alice lawsuits, the ecosystem has been in a state of waiting, stifled. What should entrepreneurs, particularly underrepresented founders and those invested in driving ESG value within an organization, consider today as they grow their businesses? How should they think about capital, partners, talent? What advice do you have?
I mean, first and foremost, I think it's awful what the very powerful people have not been doing in the last 2, 3, 4 years, especially in the US, when it comes to both ESG and diversity in the VC ecosystem, right? I always say, and I'm continental European, this is a real background. I'm sitting right in the middle of, actually not exactly Europe because I'm in Switzerland accidentally at the moment. there were lots of pledges and lots of promises and lots of we're going to change this for the last decade, and the action has been very, very meager at best, right? If you're looking at the statistics of how many entrepreneurs who don't look like me get money and have been getting money over the last years, and how many VCs have been getting money, it's awful, right? So I actually would say you entrepreneurs are all doing your job, especially the entrepreneurs who are women. My partner is an entrepreneur, two women, two female founders running a healthcare business. They're feeling it at the moment as well. And people of color and anyone, again, who isn't a white man with an elite degree. You're all doing your job. It's everyone else who needs to finally stand up to what makes financial and rational sense, right? We know that if you do diversity, inclusion, and equity right, this is good for everyone, financially speaking. This is not just about woke capitalism and doing the right thing. It also is, and that's a nice quote unquote side effect, or for many of us, the main point. But the good news is that we have every reason to push the capital owners and the capital investors, the venture capital investors, among others, to do more of that, because as a matter of fact, they're missing out on financial performance. So I'm mostly looking up. I'm mostly very keen to say, everyone on the ground, put your head down, continue doing what you're doing, don't change anything. You're doing a great job, and everyone who's been working with you should help you more and support you more. But who I'm trying to lobby are the LPs, the asset owners, because we know, as a matter of fact, they're not making the money that they could for the pensioners whose money they're managing, for the taxpayers whose money they're managing, for the endowments whose money they're managing, partly out of fear for the big venture capital funds like Sequoia and Andreessen. And that's what's been frustrating mostly.
Thank you so much. Speaking of LPs, we often think of Europe as being ahead of the rest of the world in advancing ESG. What are you observing right now in Europe regarding LPs and their approach to ESG?
I mean, the good news is this is all a very American conversation. All the frustration that I just voiced is very, very, very focused on looking over to the west, to the other side of the Atlantic, where I spent a decent chunk of time, so I'm exposed to that enough to comment on it. But it's quite different here, right? We always talk about the comparative angle, Europe versus the US, as the US is very up and down. There's a lot of ups, and again, we're changing everything, and we really care about this. We're pledging, and we're promising, and we're signing. And then it very quickly comes down again, and nobody wants to talk about it, and nobody wants to do anything. Europe is not like that. There were no pledges, there were no promises. It's like that, right? It's a bit like this particular slope of the mountain. It goes slowly, but it goes, and there's no back, there's no down, right? And the good news in Europe is 60% of the venture capital funding last year came from states. From an American perspective, we can think about the state or states, whatever we want. They're decent money managers in Europe, and they're reliable, and that's a good thing, right? These are the bureaucrats and the technocrats, not the politicians who are making these decisions. That's quite different from the issues that we're seeing in Florida or Texas with politicians deciding in one direction or the other. In Europe, it's technocrats and bureaucrats. And they took their time, right? They took their time to think about what to do about diversity. They took their time what to think about ESG, and especially how to kind of push it down into the venture capital and ultimately startup ecosystem. But now they've made up their mind, and they've taken decisions that put ESG on everyone's agenda. And we always say you can't at the moment already raise a fund that is significant, especially in the European context, say 50 to 150 million, without doing ESG quite meaningfully. Because as soon as you do that, you ultimately depend on money from the European states, and they have very good, very meaningful, often quite bespoke rules and requirements around ESG and diversity increasingly. And that's good news, because we're also seeing lots of the Americans who are ultimately facing a choice, right? There's quite a bit of the tourist money, so people who haven't historically invested in venture capital as asset owners going away for good reason. They all overexposed themselves to venture capital and the startup ecosystem in the last decade. So that's stopping. They're not putting more money in. So the American VCs who are giving you guys money, they have a choice. They either go to Saudi Arabia and Dubai and get the 500 million check, or they do a tour through Europe and go to the family offices and the state funds here. And that's ideologically quite telling what they choose to do. And it's not all public information, but it's the information does a great job reporting on some of this. I think there's quite a pull that some of this regulation and some of this LP requirements that we're seeing here now is also having on you guys. So that's great.
Super, super interesting, Johannes. And just to double click on that a bit, how much pressure, if any, are general partners or GPs getting from their limited partners on investing in diverse founders and on diversity, equity, and inclusion more generally?
Now you make me talk in a very frustrated way again. So the unfortunate reality is very little, but there's very, 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 very few LPs who say you absolutely need to change the makeup of your GP base, the whatever fund. They all, and I don't sit in these conversations, so I don't know what they look like, but they all promise me we are asking. We are every single time they come to us and want money again, and this also includes some of the Americans at least. We are asking the senior partners, look, we've been having this conversation for a decade and nothing has changed. Do you really think you can't diversify your partner base in particular? And most importantly, and this is something that Elliot Robinson from Bessemer said on a panel actually also hosted at the Nasdaq Center 2 years ago, when we're looking at the E, right, the equity, who has power and who has money, that's what we need to focus on, not who has the title partner if that title doesn't come with economics and with decision-making power, right? So that's what the LPs get to see, and they are some of the only people who get to see that. And they're asking, but they're not asking them to change necessarily, right? They're not at this point, and I hope yet, where they're saying, if you're not changing until you're doing fundraising again, we're not going to write you the same amount of check. That's what we need to see. What we are seeing is a little bit of the opposite. We're seeing more a carrot approach, at least from some LPs, than a stick approach. And I'm not 100% sure, and we are not 100% sure, neither from an academic perspective, which is what I was in my former life, nor from an industry practitioner perspective, whether this is a good idea. But we see some vehicles. The German Sovereign Wealth Fund just launched a meaningfully sized 250 million facility that's only for VCs that have a diversified GP base, right? They only care about the GP. Nothing else matters. So in a sense, trying to start a second or different flywheel rather than changing the established flywheel. The problem here can be timing. How many generations are we going to wait until that flywheel is the size of that flywheel? And still, especially from the perspective of these state LPs in Europe, you do have the power to tell these guys, we're not re-upping with you if you're not changing the makeup of the LP base, right? And for all of you in this room, the GP base is what really matters, right? I think some of you might have already been in touch with VCs, have raised from VCs, and might have been frustrated that the kind of junior base of VCs, the associates and juniors running around, they look a little bit more diverse, sure, but they don't have any decision-making power. So in the end, that doesn't really help that much, right? You need the people who sit in the ICs, in the investment committees, to represent the ecosystem that they want to invest in. And that's not yet happening. And there's very little pressure through the system to change that, really, unfortunately.
Thank you. Thank you for sharing that. Stepping back a bit for a moment, what would you say defines an effective ESG strategy? What is important for businesses today? And then how do you measure effectiveness or continuous improvement?
Yeah. So for the founders in this room, which I think is the majority, the most important thing is to not be overwhelmed by reporting. The world, and this is public markets as well as private markets, increasingly, unfortunately, spends all their headspace that is reserved for ESG talking about reporting. And that's the least important and the least impactful and the least efficient and the least effective thing you can possibly do. Partly because the KPIs and the metrics that they're asking you to report on are mostly just nonsense, because they come from the public markets and they just take the stuff that they've been asking the corporate world for a decade and put it in front of you. And none of these metrics makes any sense for you guys. And that's normal and that's good. And I wish more of you could push back. I know that some of you are not in the position. That's what we do at Venture ESG. We're trying to get people to focus on the important bits, and that's not the reporting. The reality that you're facing in Europe, if you're expanding there, if you're based there, is that you will have to do some of this reporting. We're working on making that as efficient as possible by unifying and harmonizing what the LPs are asking for, because that's where it comes from. And then it shoots through the GPs down to you guys. And that is a massive hot mess at the moment, which, again, I think hopefully most of you are not exposed to at the moment. But that's really not what you should focus on. So minimize that as much as possible and focus on the material ESG issues. Or very simply speaking, all of you have different businesses, all of you are in different stages, all of you are focused on different sectors. Your ESG strategy needs to look different. It's not a one-size-fits-all approach. You need to do a materiality assessment, which is just a very, very fancy word of figuring out which of the ESG issues are important for you. Is it diversity? Do you need to think about, because you're building an AI product and you want to think about building a not too biased AI product, who your engineers are and where your data comes from, right? Then DEI, especially in the hiring and talent processes and in the engineering processes, is a material ESG issue for you. Or are you building a fintech and really you're looking at collecting an enormous amount of data? You need to think about data security. That's your material ESG issue, and it might not be that, right? And if people push you on doing all of that at once, that's also a mistake, right? Be distinct about setting goals, and I think that's where the measurement comes in as well. What is it that you focus on in this particular 6 months or 12-month period? Set a goal for yourself and measure yourself as you're walking and working towards that goal, right? And these don't have to be KPIs and metrics that come in numbers. They could be much more unspecific, as some people might think, qualitative assessments of, we're doing a good job in mitigating bias in our data collection for the AI that we're training.
Excellent, very practical, accessible advice there. And in closing, what is one key action founders can take within their organizations today to ensure their long-term success in this area?
Assign responsibility. This needs to hang, and I understand this is a varied field of people in this room at the moment. This needs to hang reasonably high. Doesn't have to hang with the CEO, but it should hang in an environment where the board thinks about this on a reasonable, regular basis, and then delegate it down. But the responsibility is key. If nobody is responsible, nothing gets done. And you can start that when you're 5 people. It's actually much easier to start this when you're 5 people.
Excellent. Thank you so much, Johannes. And I believe Colin will take us from here.
Yeah, well, thank you, Amanda. And Amanda and Johannes, what a great way to start the day. Thank you so much for joining us, Johannes, from Switzerland, and love the background. And Amanda, again, we'll see you back for panel 2. So thank you both so much. Okay, folks, well, up next, we're rolling right along. We're going to have our panel on how ESG can create competitive advantage for entrepreneurs. So please join me in welcoming, first off, our moderator, Lisa Schmidt, is a senior ESG strategist at Nasdaq. We've got Claire Vuthi, who's a principal and founder at Rhizuma, Robert Terenzi, who's an associate at Wilson Sonsini, and Jeff Reinhardt, who's a partner at CityLight Capital. Team, welcome. And Lisa, over to you.
Thanks, Colin. I think what we'll do just to get started is a quick intro from everybody, from their backgrounds. I will get started. I have been in the sustainability space for roughly 5-ish years, going from Deloitte Consulting, doing sustainability strategy, and have been at Nasdaq for about 3 months, so relatively new here on the ESG advisory team, but bringing a lot of experience with me along the way. I'll go ahead and kick it off to Claire if you want to give a quick intro.
Yeah, thanks, Lisa, and thanks everyone for joining. Happy to be here. Claire Vuthi at Rhizuma Ventures. We are the boutique sell-side M&A firm for climate and sustainability companies. I've been in sustainability for a really long time. I think I'm pushing 20 years. Worked with a couple big public companies and a couple of young companies that kept being acquired. So I've been in seats kind of researching and rating companies on environmental, social, and governance issues, and then investing using that information as well, and now helping companies sell when they're ready for an exit.
Awesome. Thanks, Claire. Jeff, you want to give a quick overview?
Yeah, happy to. And likewise, thanks for having me. Excited for the conversation. My name is Jeff Reinhardt. I'm a partner at CityLight Capital. We're an early stage impact investing fund in the US. So we invest primarily in 3 sectors: education, climate, and healthcare, everything from kind of pre-seed through A. Firm's been around for 20 plus years. We're market rate return seeking in terms of what we do, and spend a bunch of time thinking about measurement and quantification of some of these metrics. So happy to get into that. Prior to joining venture, I spent 20 years as an operator, half of which at Capital One, where I started as a statistician. So I'm a math guy by training. And then the last half in various startup ecosystems, I've kind of evolved into marketing, was the chief marketing officer for an education technology company that went, through all the gates and raised a bunch of money and went public on the Nasdaq. So I got to ring the bell at the Nasdaq. That was fun. And was a professor for a while, and then wound my way into venture.
Thanks, Jeff. And last but not least, Robert.
Hi, yeah. So I'm a corporate attorney with Wilson Sonsini, focusing on kind of tech companies based in Latin America, and then on impact investing and ESG compliance. I actually started Wilson Sonsini in like 2010 and was there for about 4 years, and then left to start my own company and lived in Nicaragua and Colombia for 10 years working on the coffee supply chain with the social enterprise. So I come at the ESG kind of questions from both the legal angle, but also as a former venture-backed founder. And thank you so much for having me, and thanks for the Nasdaq Entrepreneurial Center for hosting this panel.
Of course. So just to get into some of the questions here, general question to the panel, so whoever speaks first wins. What does ESG mean practically for startups?
I'm not
sorry. So go ahead, Claire.
Sorry, I'm not sure this clears the practical bar, but I think historically ESG for everyone has been issues that don't fit on the financial statement, right? It's, in my view, an acronym that's perhaps finally kind of on its way out, but it's been a catch-all for things that folks kind of think or suspect are important, but like don't know where else to stick. I think increasingly those sub areas are acquiring names of their own, right? There's like climate and human capital and diversity and cybersecurity, and it's been a very elastic term over the years, which has been convenient for folks like me who work in ESG, right? Like that the work is never really going away, but I think thankfully it's really matured into a set of concrete issues. And I think Johannes made a number of really good points, including that it's a little bit different for every company, right? Like the industry, the geography, the stage, the business model, all of that matters. So it's actually like a surprisingly hard question to answer in a generic way.
Yeah, I totally agree with that. I think that's a great way to frame it, and also agree. I like that point that Johannes made. It can be, as a math guy, it can it can be easy to want to just kind of get in and, okay, let me get the checklist and let me start doing all these things, because that's what ESG means. And we'll get into kind of how this evolves at an early stage, but I find well, I like founders and companies that are trying to kind of move in that direction. It can be a bit overwhelming, and you ultimately end up building a bunch of stuff that isn't particularly relevant to the thing you're trying to actually achieve. So finding those things that are resonant and relative to the business you're building and getting really good at thinking about those and moving forward, I think is what's important. At a high level, I also just think some of this is it's just good business, right? Like it just makes sense. So like, what does it practically mean? Like some of this is just like logical things you should do. It's not this ephemeral thing over there that you need to make a decision to go do that's different. Some of it's just obvious that you as founders should be doing.
Yeah, just to add to that, I kind of look at it as almost like applying the scientific method to your startup. So you're measuring certain data at regular intervals to kind of test your hypothesis for growth as a company. And so I don't think you need to implement, like Johannes was saying, everything all at once. And it doesn't have to be altruistic or like philanthropic. It can be really self-serving to the company, as kind of Jeff was saying. So like companies should focus on what drives value for their particular enterprises, what unlocks access to capital, and like improves the brand as a whole, I think, as an approach to ESG at an early stage company.
All great points. I think next question, I'll move to Claire specifically. What are some of the common misconceptions about ESG, and how can a startup avoid them in their own business practices?
I mean, I think Robert and Jeff kind of touched on this, right? It's like we have to do everything now, and we have to do it at the same level as we would if we were a big public company. Like, I mean, that's patently nonsense, right? I'm like exaggerating for effect, but I think there's a concern, and this is not just from founders. Like I've heard it from early stage investors who do a lot of climate, et cetera, type investment. They're like, oh, they're focused on product market fit now. They'll get to that later. And I'm like, no, this is part of it. Like it's part of who you bring, right? Your capital stack, your cap table, who you recruit, how you build your product, how you sell. It's part of your culture. And I mean, there's the danger of diluting it if it's part of everything. But to Jeff's point, like it's part of how you do business. It's how you operate. If you think of yourself as a node with no effect, or if you see as yourself like existing in a system and that you participate in other systems. So I think the danger is both like trying to do too much or not doing enough. And I think it's a tricky exercise to thread the line between thread the needle, I guess, between like the right metric or 2 or 5 or 6, but probably not 50 that you should be starting to track at an early stage. And you really want those to basically be business metrics, not like separate ESG metrics, in my view.
Right. Right. Something we've seen on our end is ESG as a notion should be kind of woven into the fabric of the business. So it helps you make strategic choices, saying no to certain things, saying yes to the other things, instead of, to the point of Johannes, reporting only, right? Let's build it into the business and build it into our offering and strategic positioning, rather than let's just tell people what we are doing. To open it back up, what are some of the opportunities and risks for early stage startups by having that ESG strategy?
Yeah, I think we've hit a few of those, but like I want to underline something, and also like there was one thing that Johanna said that I want to call out and make a distinction. He's not here anymore, so I could be making a distinction that he didn't intend, or I'm going to say something that he doesn't agree with, but I'm going to do it anyway. Like what I wouldn't want people to take from the comment that he made is, that reporting is useless. I don't think that's right. I think reporting on the wrong things, right? Reporting just because I got the list and this is, what I'm supposed to do, so I'm going to go do that, and this isn't relevant to my thing, and like that's bad, right? Like there's risk to that, getting in that footing. But I'll make the distinction between reporting and measurement. I actually think measurement does matter. And having the ability to kind of articulate, once you identify the things that are important for you and your business, you had the ability to kind of measure and report against those. So, I'll draw those distinctions. The risk, I think, is, or a risk, is that just getting swallowed in things that are just not helpful, right? Like a founder's time, it's a constrained optimization problem. And if you're spinning a bunch of wheels doing things that aren't helpful, like that's a big risk. Opportunities, I'll stop because I'm rambling on, but I'll go back to, it's just good business, right? Like, the G side of governance, bringing in a diverse group of people, or setting up, a compensation strategy and equity incentives to make sure that everybody is incented, in the right way. And like all of those things are just going to help you build a better business. So I don't know, that's my take.
Yeah, one cool thing I've seen kind of on the opportunity side, to piggyback on Jeff's point, is that, at the later stage company and public companies, finance and ESG reporting are so intertwined, they're basically inseparable. And early stage companies are notoriously bad at accounting and finance, usually because they're prioritizing, validating the core business over passing an audit. But one cool thing that I've seen is if founders can get buy-in from their employees and from their team to regularly update financial metrics, if it's part of an ESG kind of goal or set of metrics. And so you can incentivize the more kind of mundane or boring parts of record and bookkeeping by making it kind of a team effort toward a sustainability goal, or towards proving out like a governance issue or a social issue that you're having on the as the company's mission as a whole. So I think that's a pretty cool like opportunity side of ESG implementation at an early stage.
Right. Yeah, that makes total sense. Moving towards Jeff, one of the key takeaways from COP28 was that there's an available capital in the ESG startup investment space, but a lack of defined bankable companies or bankable projects to allocate it to. How can purpose-driven founders gain more visibility into that space?
Yeah, it's a good question. Let me come at it two ways, in terms of the general premise first, and then I'll kind of get to the actual advice of how do you get more exposure. I think some of that premise of like there's plenty of capital that just can't find the things to deploy itself to in this space. Some of that may be true, but I think some of that is just like kind of a structural issue with kind of where the capital sits in some ways. Like if you think about capital that's being deployed in and around climate or ESG broadly, it ranges from, government grants and philanthropy and concessionary capital through, impact and market rate return seeking vehicles to generalist VC and private equity that, happen to be investing in just good tech deals and so on and so on. And like, I think all of those are really valuable. Like if we have any hope of impacting something like climate change, like all of those things play a part in moving us forward. They're all really important. But we often, as a player in those ecosystems, kind of have these like broken silos where, if somebody comes and I'm a market rate return seeking vehicle, and I think there's clear impact, but it doesn't meet that need for me. It just kind of falls away, as opposed to me having a natural connection with the next person in line where that's a perfect fit for, right? There's not good fluidity of that. So I think we as like allocators of capital need to do better at kind of managing that continuum and kind of moving opportunities to the right place, or helping to move opportunities to the right place. And then, from a founder standpoint, I think exposure to that, I think it's useful to know that there are those pieces, parts of an ecosystem. It can be easy to fall in the trap of, well, everybody's raising VC, I should raise VC, I should go talk to a VC. That's not always right for everyone, for sure. And, kind of understanding the various options that you have, where the various pools of capital are, and what may be right for you at one stage may not be right at another stage. So just thinking about all of those things. And then, I think we'll get into some of this as we go, but like starting to build network and community across like founders, across investors, going to the right conferences, doing all those things, just getting out in front of people, I think matters.
Yeah, I think I'll echo that point of, I guess in this space, it's not necessarily industry collaboration, but collaboration across the financiers instead of straight up only competition, I think is something that we are seeing companies and financiers pivot towards, is collaboration rather than just straight up competition.
Totally.
Moving forward to Robert, what are some of the key legal considerations for startups looking to establish a strong ESG foundation?
Yeah, I think that it can be really basic and simple at an early stage company. So like you can be doing well as on the governance side of ESG as an early stage company simply by having like a well-organized data room that investors can access with your corporate records, or like holding board meetings regularly and having a track record of minutes, even if it's just two people, having a phone call. And so I think that there's a lot that companies can do that will set them apart from a bunch of other competitors or other startups in the space, simply by just keeping good record of their corporate history. The other side is that governance can also include having a diverse board, and which is part of California's new governance requirements for public companies. And the data shows that having different perspectives on a board can broaden the product's appeal to the public and lead to all sorts of improved metrics for a company. And so, and then also on governance, there's the emergence of kind of some more exotic corporate structures like the Public Benefit Corporation, 10, 15 years ago, and things like that. I was initially a little bit sour on the need for those, but the rise of shareholder activism against ESG has I think reinserted the importance of protecting a mission-driven company by hard coding that into the charter documents, into the company's DNA. And so I would look at that as kind of a governance piece. On the social side, one piece that's really important for a lot of regulators is data protection and consumer privacy, and establishing programs where you are minimizing data collection can help environmental metrics, but also protecting data and protecting privacy can help protect the company from future claims against data breaches and leakages and stuff like that. One risk, I think, and one thing that's a little bit worrisome to me over the last 10 years of raising capital and then representing companies that raise capital is like the standardization of ESG side letters. It can be really easy as a company when you're getting towards the end of a negotiated financing with an investor to just see the side letter at the end, agree to a bunch of reporting requirements, and not really have them tailored to your business or appropriate for what you're working on. And so, that gives rise later on down the line. If you don't report on something or you miss a quarterly reporting, like nobody's going to care if the company's doing really well, but it can give rise to a claim of like contract breach or failure to like, it can sour investor relations when they look back at the history and say, oh, you missed reporting requirements here. You didn't give us this metric on environmental emissions, whatever it is. And so I think that really, like, if really tailoring metrics that are core to the business, like, for example, at my coffee company, we track the amount of organic coffee we sold versus conventionally grown. We did that not just for the environmental benefits, but because we charged more for organic coffee. So it was a core financial part of our process as a company as well. And so that is just something that I would, advise companies that are raising capital to really think about the commitments that they're making throughout the financing process.
Yeah, I think it comes back to don't just throw the kitchen sink at it. Make sure you're strategic in the decisions you're making, and that moves into the contracts that you'll be making with financiers, et cetera. Claire, next one's for you. How can one integrate ESG considerations into a startup's business model from the get-go, even with the limited resources and time?
Yeah, I think again we've touched on some of this, but maybe I'll try to give a couple practical examples in addition to one Robert just offered. Again, it depends on what you do. I think what's very common to all certainly early stage startups is you're probably trying to recruit people, or you're planning to try to recruit people. So there are probably some sort of basic systems and tracking that you can put together in the beginning, and it could just be one, set up a little bit of a process for when you assess and interview candidates, and two, try to make them consistent, particularly across, for example, referral candidates and like cold inbound candidates, right? Or folks that you reach out to. I think this is, again, really tricky at an early stage company in particular, where you really need to be working with a high level of trust. It is easier. It makes a lot of sense to bring in folks that you already know and you've already worked with. But what often happens with that is that not the scrutiny level, but the process is much lighter or kind of expedited. And again, all of this makes sense. Like, I don't think people are trying to be nefarious, but it means that you're probably just piling on in the beginning with folks that you've already worked with. There may be an element of groupthink, right? And it's important to try to set up some basic processes to like keep yourself from that in some way. So I think it can be really simple, right? It's saying, okay, before we know we need to recruit someone to step up our marketing, what do we need this person to do? What kind of evidence are we looking for? Like, what are the character traits, as much as we can tell? Like, set that out before you talk to any candidates, so you don't like fall in love with the first 3 or 1 or 2 or 6 that you meet. And then, do your interviews, grade them or something, like try to distill it in a way that's relatively objective across the 6. And you may decide along the way that actually the criteria you set out were not useful. But I think the exercise is useful to sort of force yourself to make a decision based on something that's a little bit more objective and consistent across candidates, instead of like the feeling you have walking out of the interview, which I think is basically how folks often do interviews and make hiring decisions, if they're not given more specific either instructions or have thought more specifically about what they're trying to bring on, right? So it's not hard. It doesn't take a lot of time or money. It does take a little bit of intentionality in thinking about it and like following through with something that may feel a little awkward, like a little overwrought in the beginning, when you're like, we're just trying to bring someone in to do marketing. Like, we can't spend 6 months on this. But I think there are a few light processes you can bring in to sort of start to document. Similarly, early stage startups, it's not uncommon for there to be a lot of churn, right? Every now and then look back and be like, hey, we had to let some people go, some people left. Do we track any of that data? Like, it's probably not that hard to track, but you might look back 6 months later and be like, wow, every new manager that reports up to this person has left after 4 months. Like, maybe there's something to look into there. Are we not setting them up for success? Is this manager not like, or is the leader that these folks are reporting to not, is like, what's wrong here? How do we fix this? And how much of it is, it's easy to just be like, they weren't a fit for us, but like, it might be a little bit more nuanced, or you might have more control over that than you realize, right? It might not just be like candidates who don't know what they want come in and then leave. So I think there's a little bit of like stepping back and intentionality that can be done very early on. And then, similar processes for customer discovery, product design, again, thinking about who's on your cap table and who you want to bring as your investor base on your advisory board. Like there's lots of ways that you can try to be thoughtful about this. And it doesn't mean keeping anyone off your advisory board, but making sure like not every single one of your advisors is like from the same position in the same industry, right? That might, unless you're only selling to that position in industry, which in case you should have that knowledge, not just your advisors. So I think there's a few ways that folks can just be thoughtful about how to implement this really early on without a lot of resources, assuming you're working with humans, which at this point, I think most companies still are.
Yeah, sounds like intentionality from a human capital strategy perspective can kind of run the gambit and make sure that you're actually seating the table with diversity of thought that will continue to push your ESG journey forward. So I appreciate that perspective. Jeff, moving towards you again, how can one effectively communicate an ESG commitment to stakeholders, including investors and customers?
It's another great question. I think one of the things I'll say, so there's a how do you do it effectively, and I'll come back to that in a second, but like in the external channels that you're communicating, your website, a pitch deck, whatever it is, make sure you're actually communicating and not just assuming that it comes through. Like I can't tell you how often like somebody will come and talk to me and they're like, well, I'm building a mission-driven company that does these things and it should be obvious. But when I look at the pitch deck or when I look at their website, they don't talk about any of it at all, like none. That dissonance matters, right? Like it makes me question, like, are they really kind of thinking about these things? So first step is actually communicate. Then like, okay, how do you communicate effectively? Maybe I'll spend a little bit of time on this one just because it kind of lands on it. I mentioned the distinction between reporting and measurement, and how do you think about measurement? I think Claire did a great job in the question before, talking about just being intentional about once you've identified these are the things that matter. It doesn't take a lot of time. It doesn't take a lot of money most of the time. Just kind of start putting those things in place where you're actually starting to report on these things, where you actually can communicate them. And what I've found, like there's some businesses where the measurement reporting is obvious, right? Like climate companies often have an easier, more direct line, like to carbon sequestration or whatever it may be. When you get into things like healthcare or education or all these other things, these things matter as well, but the common denominator metric that you're getting to is often all over the place and can be trickier to measure. It is often easier for a business as it scales if you can tie the measurement to just business KPIs you're tracking regularly. And often a way to do that is to kind of tie a business KPI maybe with some research, and then that kind of gets you to outcomes. I've seen an effective way to do that. I'll give you a couple examples. I'm on the board of a pediatrics company that does primary and urgent care. And one of the things they found to be true is that traditional urgent cares, like general urgent care, patient first, tend to refer kiddos to emergency rooms at much higher rates than they need to, because they're not set up to deal with kids. They don't have the right size tables, they don't have the right size needles, whatever it is. And emergency rooms are really bad for kids. They're more expensive than they need to be. The care isn't as good. So, okay, that is in fact the state of the world. They know for a fact the percentage of kids they end up referring to an emergency room. That's tracked, it's easy, they know that. There's very clear research that's out there around the average referral rate of kids to emergency rooms from general urgent cares. And there's very clear research on the impact of kids in emergency rooms when they don't need to be there. You put all those together and it actually gets you real cost outcomes, health outcomes, in a way that isn't that hard for the business to measure because they're already tracking it, right? So figuring out ways to get to outcomes that matter, that will resonate not only with investors, but by the way, that now is something that they talk about on their website, that they talk about in all hands, that are like relevant when they're hiring people, that like, this is how we're actually helping kiddos, right? Like, so what I find is when businesses can get into that parlance, make it easy because it's tied to business metrics, maybe with some research in the middle, it really does kind of change the way that they talk about things. That's why like I land on measurement is often important.
Yeah, it comes back to when you are weaving in ESG into the fabric of your business, making those strategic decisions. So that one, for example, is a large strategic decision that you can then track and then report on and increase confidence and potentially have an increased investor base. So that makes sense. And I
Lisa,
appreciate the example. Go ahead,
sorry,
Claire.
can I jump in here? I just want to,
Please.
I think that's a really good point, Jeff. And I think there's actually a little bit here that we can borrow and learn from, honestly, the like nonprofit world, right? There is a large established base of practice and research around how to measure impact. And that's often very resource intensive in a way that's not realistic for an early stage or even a later stage startup. But I think there's some concepts there that we can borrow, right? The idea of like, what's the counterfactual? What's happening without you? Yeah. And Jeff, not to like nitpick, but like sometimes what we're looking for is good or better estimates. Like you're not actually measuring the effect on the kids who didn't go to the ER. You're measuring based on the data that we know. And this is probably a time box, like 90-minute project for someone. Like go find that baseline study, maybe find a few of them, pick the one that's most relevant to your geography and socioeconomic background, or, you know, whatever, like is the closest fit to what your company is trying to do. And then use that. And like maybe every year someone should time box another hour to see if there's an updated study. And that's it. Like you don't have to, it doesn't have to be like an ongoing, really resource intensive project for a statistician, unless Jeff has a lot of extra time to volunteer. It's probably like a little bit of smart research around a counterfactual kind of baseline study, and then tracking your own metrics, which you should be doing, and hopefully it's not too hard. So like better estimation to make that case.
I appreciate that extra context, Claire, definitely really helpful. Robert, punting it back over to you. We've seen the importance of ESG reporting in later stage companies. When and how do you think this will trickle down to early to mid stage companies, if ever?
Yeah, so I really like this question because it kind of points to what Johannes was talking about with, like, in Europe, it's just kind of steady climb up, and in the US, it's a little bit up and down, but overall the trajectory is up towards more disclosure and more ESG kind of initiatives. I think that you are already kind of starting to see ESG requirements trickling down to companies in a few ways. One is the disclosure demands on institutional investors and mission-driven investors who use grant funding. So large investors that have venture arms will likely be demanding disclosure from their portfolio companies, and mission-driven investors who have to give reports on how they're using grants to fund impact companies or kind of double bottom line companies are going to have disclosure requirements as well. So they're going to be asking companies for metrics and for the results of their ESG efforts. It's not at the SEC level of complexity or sophistication, but you're still starting to see that trickle down farther. And then second, larger companies are going to start reporting scope 3 emissions, which are those kind of generated throughout the broader supply chain, either through the implementation of the SEC climate change rules whenever those happen, or via like pressure from consumers who want that kind of information when they're making decisions. And so in order to be a good partner to large corporations, which is oftentimes the fastest way a company can grow, private companies are going to have to comply with like an ESG reporting regime. And then finally, kind of getting back to the self-serving nature of ESG for a company, like a lot of grant opportunities related to climate change are going to require a history and track record of environmental record keeping. And then also just having a regime in place where you are keeping track of stuff, like I said earlier, like will show a maturity and a readiness for a broader market, even if it's not necessarily required at that stage of the company. So I think that that's kind of how you'll see those things kind of start to be voluntarily and then just via market demand implemented at an earlier and earlier stage.
Right, we've definitely seen. Go ahead, Claire.
Sorry. We're seeing some of this already, particularly with greenhouse gas reporting, right? And Robert, I'm sure you see a ton of this. Yeah. As he mentioned, through this supply chain effects, right? If your client is Salesforce, you've been hearing about this for years, and increasingly that's going further down. Also, California laws passed at the end of last year directly affect companies like fairly down the market cap. It's pretty, what's the law? I think if you do $500 million in revenue, not necessarily in California, but you have operations in California, which is fairly loosely defined, you need to put forward some reporting on your climate risk management, which is kind of hard to do if you've never done a carbon footprint. So like you can, right? If you do a thoughtful risk assessment, like at least I'm sure you see this every day, right? Like you probably need to do a first footprint. So It's not when, like this is already happening. I think some companies are waking up to it a little bit belatedly, but like the stuff hits next year. It's not like way later. And then private equity companies, I think this has died off a little with the rate change over the last 2 years, but even like mid-market private equity was thinking about ESG really hard in 21, right? And the beginning of 22. My experience is a lot of those folks have vaporized over the last couple of years because I think they had an excuse to look at something else, but I think it'll come back.
Appreciate that extra context. Just as we're getting to the 10-minute mark, question to the whole panel. I know we've kind of gone back and forth on this topic a little bit already, but how can a strong ESG approach give a startup a competitive advantage? And if so, how?
I briefly touched on one point that I found important, both having been inside of a company that really focused on mission and raised impact dollars and did all those kind of things. The hiring thing and the retaining talent thing is real.
Yeah.
It definitely is, right? Like people want to feel like what they're doing with their day matters. And all else equal, if a great engineer has an opportunity to go do something that, has purpose and a meaning, and it's clear what they're doing, or go do, next tech thing that is kind of amorphous. More often than not, you're going to win that and get that talent and retain that talent. It's real. I've seen it. It was a part of the journey. Like that matters. Now to do that, like, you need to be able to articulate that. You need to be able to have that purpose, that clarity. Like it needs to be a part of all hands meetings, right? Like it needs to be a part of the DNA. But if that's true, in addition to satisfying all those things, attracting and retaining talent, and you want to talk about a leg up, like attracting and retaining talent is kind of everything. So that matters a ton.
Yeah, when I was thinking about this, like there's a line from the show Dexter, which is like, there are no secrets, just hidden truths waiting to be discovered, which is admittedly super creepy in that context. But like in this context, I think what it means is that like, for me, like a successful ESG program is really about monitoring the fundamentals of your business and discovering problems before they are fatal to the company, or discovering opportunities, be it funding, cost saving, or broadening the appeal of your product. Just by doing like active market research and by monitoring like just basic stuff in your company. And so I think that like the earlier on you can really do a deep dive on your company and how it's working, you're ahead of 99% of your competitors, I think, in that sense.
Yeah, I'll preempt our next expected question, since I think Jeff kind of answered it, and I'll add a little bit here. I think a lot of this depends on, again, what's relevant to your business, right? So if you're a banking as a service company, then you need to be thinking about data privacy and security, about, who your customer base is, how you access them, what kind of financial education they need or you're giving them. Like there's a certain number of questions that are really obvious and you need to be thinking about. Like the environmental impact, especially in the early stages, probably not the top of your list. And like, that's okay. I think when you start getting big and use a ton of compute power, maybe you can think about it more, but like probably not really relevant or worth a lot of brain cells in the beginning. So like be smart about how you allocate that time, and like be thoughtful about the couple of things you want to track. And I say track again, not because the metric is everything, but it's like a manifestation of this intentionality and the strategy and follow through that we've been thinking about, or it can be.
Right. How do you see progress without some kind of measurement mechanism, whether it's estimation or actually hands to keyboard tracking it in an Excel sheet?
Yeah,
So
and I'll just say, I've worked with some, as I alluded to, kind of middle market private equity companies, and they're, to my surprise, and folks on the panel probably know this, but like surprisingly similar to early stage venture, in that they're still very founder executive oriented. Not a lot of systems, right? There may be more services and less tech, but other than that, like really similar companies, maybe they've been around a little bit longer. And that's good and bad in that you often have a really strong kind of magnetic, compelling leader who thinks that how they see things is how the whole company operates, right? And they're like, oh no, but that's not how we do business. You're like, that's great, but it's literally written down nowhere. And when you plan to hire 20 more people because you just got this infusion of capital, how exactly do you expect to pass that on? So right now your employee handbook was clearly written by legal as a risk management process, not as a like useful thing for your employees. how do we change the tone a little in a way that helps, like feels less like a compliance document and more like a you're part of the family document. So there's some elements here that are a little bit about tone and practice and like institutionalizing a little bit of how you want to think and operate, particularly as a founder.
Awesome. Just noting with 5 minutes left, we'll probably get to 2 more questions. So Jeff, when we're thinking about ESG focused investors, how can one leverage those ESG considerations to attract capital from those investors?
Yeah, I mean, we talked about like, don't just assume you're communicating, like communicate and, talk about the right things and make sure that's out there. I touched on a little bit at the beginning, but get in the network of where those investors are. Go to the right conferences, right? Like, there's sort of general conferences like SOCAP or, there's impact capital managers and, just for your particular area of focus, do a bit of research and figure out like, where do those investors live? Where do the founders that sort of, how do I get in those streams? How do I get in those networks? It's from there that those connections happen, and I think you get value from being in those networks in 2 ways. One is the direct to your question, how do you get in front of the investors and share that information? So there's that piece. But I also think like being a founder and early stage executive, like it's a lonely job. It's hard and it can be lonely, right? Because in particular at early stage, you tend to not hire a bunch of like C-level people underneath you, right? Like it just doesn't make sense. So building a network of like-minded peers can be really helpful in a whole bunch of ways. So I just think that you get a bunch of accretive value out of like finding those pools of people and immersing yourselves in them.
Definitely. And that, I mean, we talk about reporting a little bit and metrics. I think those call outs that you made more so give you the ability to have that more tacit information sharing where it's not necessarily written on a report, but you can talk to those investor communities, talk to your C-suite peers and have some of that tacit learning going back and forth between each representative. Last question before we'll get to key takeaways and investor Q&A, or sorry, the Q&A box from the attendees. Based on our conversation, I know that there are some of the call outs that we've made on ESG as a value driver. Some of those are lower cost of capital, product offerings, better access to talent, et cetera. Without a crystal ball within the next year, where do you see the trend of ESG as a value driver moving towards?
Can I have a crystal ball? Is that an option?
Fortune teller Jeff.
Oh man. I think it was Claire who mentioned it earlier. There's been just a bit of shifting in the winds that have happened over the past year or so, and it's kind of allowed people, as you said, Claire, to think about something else. And I do see these things as kind of as cyclical, and do see that coming back. Partly because things like climate change is one of the existential issues of our time, and we will be forced to, as a human race, deal with this, and it will whether we like it or not, or the powers that be like it or not, we're gonna have to deal with it, right? Like, so that's just a thing that I feel pretty certain about. And like I said, these other things, right? Like a diverse group of people thinking about and coming up with solutions, right? Like good governance, good data security, all these things are just good business, right? They just build better businesses. So like get the idea that, these as concepts are just going to go away. I call me skeptical, right? Like, so I think they continue to gain importance is my guess, I guess. I don't know.
Yeah, I mean, BlackRock is not motivated by philanthropy or altruism when they like put ESG at the center of their, kind of investment portfolio. Like Jeff said, keeps saying it's good business. Like companies with strong ESG programs are shown to outperform lesser kind of organized, lesser like monitored companies. And so I think that, what started out as potentially something kind of in the philanthropic or altruistic like world in some ways, like has led to just a real business case for stronger disclosure requirements as the requirements get more sophisticated and complex.
Yep, I'd say, I mean, I'd agree. I think there's some high media headwind. I mean, I don't want to totally dismiss them, but not very substantive pushback right now from primarily politicians with a different agenda. What I find kind of funny is that, there's actually like the ESG backlash has been, the folks pushing that have been relatively successful in some capacities. And we've seen, can't remember the number, I think 163 bills last year at various state levels, maybe 23 of which were passed. So not a high number, but not zero. So you do have a number of states now who are forbidden from working with asset managers, et cetera, or like taking into account ESG in their investment processes, which, like, I'm sorry, that's crazy, right? You're investing the assets of the state of Texas and you can't think about climate change. Like, that's a problem. So I don't know how we're gonna like get ourselves out of that hole. But it's hard to see any of these issues go away. I think they are morphing and like changing names, and you're finding, it's energy efficiency or resilience or like not climate change or terms that folks are allergic to. I don't think any of it's going away. I think climate has grown in dominant or in, I guess, taking up more air in the room. When I started as a baby analyst, which admittedly was almost 20 years ago, climate change was like a thing you needed to think about later. And like all that is happening now. I mean, I'm hoping no one needs convincing that climate change is now, it's not later.
Right. I think something that I'm seeing is with the allergic nature to climate change as a term, something that's resonating at least to the point of like Texas investment bodies is the push towards mitigation and adaptation rather than solely on future looking, how do we kind of change the temperature conundrum. So right before we jump into the Q&A, which I've been monitoring, thank you for all those questions. I would just ask each panelist to give us a quick key takeaway or piece of advice that we've talked through from this conversation.
Okay, I'll go. I think there's a common through line as we went through that, I'll stick to as my piece of advice, which is don't go for the laundry list, right? Don't feel like you need to kind of capture and report against everything. Figure out the things that are relevant for your business, in particular your business right now, and get good at sort of putting in processes, whatever that might mean for you, to kind of measure and articulate and move those set of things. Like build clarity for you, build the things that matter for you, and get really good at that. There's always room to expand going forward, but like think about what matters for you and your business.
Maybe to add to that, I'd say don't wait, right? Start with what's reasonable, but also don't wait and say you'll get to this later. ESG for a long time has been like an important but not urgent issue. But as I kind of alluded to, we're going to have tens of thousands of companies that need to report on greenhouse gas emissions like next year. And I think 8,000 of those are unprepared, or at least like scrambling to figure out what their options will be. And they're going to do a crappy job the first couple times around. So that can be an opportunity depending on what your company is or does, but don't wait for this to become big because it's happening really quickly. Like as someone who's been in ESG for a long time, the regulatory change we've seen in the last 4 years is staggering, right? Again, as a baby analyst, we're like, one day some of this will be internalized. These are externalities. And like at some point, someone will value this. It's all like compliance now. Like Robert, I'm sure you've seen this really close, right? You're seeing roles of ESG counsel in companies. It was new. That was unheard of like 18 months ago. So it's all happening pretty quickly. So if it's clear what you should be focusing on and there's a risk of anything becoming kind of regulatorized for better or for worse, like don't sleep on it because it'll happen really quickly.
Yeah, just to add to that, like I think that anything you do in an early stage company is going to set you apart from your cohort. And so like creating any sort of a record, keeping track of things internally just shows a level of maturity and can build trust with investors, because you're going to have down months, you're going to have metrics that you don't like. But if you can like keep a regular cadence of reporting, even if it's something, like I said, as simple as board minutes every quarter, like that alone can be really it can just demonstrate a level of confidence in yourself and in your founding team that will go a long way to building a reputation with investors.
A good hygiene.
Yeah.
Definitely. So just moving into the Q&A portion, one of the questions I have here, which is very interesting. I think a lot of the conversation we've been having is very high level. What are we going to be doing from like a high level perspective? So one of the questions asking, say I'm a 5-year-old, can you explain to me how to implement ESG into a small business where they're at the beginning stage of building one's business and business plan?
Well, I have a 3.5-year-old, so I think I can take a first crack at that. My 1.5-year-old wouldn't understand this, so I'm not even gonna try there. But let's say I think the businesses that he kind of understands are like when we go to the store and buy something. So like a business with physical goods, I think other than that is a little, he knows I have meetings on the computer, but other than that, I think it's a little tricky. I guess I'd say, and he pretends to sell baked goods to me all the time. So I think I'd want him to think about where his products come from, like who made them and under what conditions, how the product is sold, right? So we're thinking about like packaging, for example, or shipment. I wouldn't use the word shipment with my kid, but something like that, like transportation, and who's working in the store, if there's anyone other than me, and are they being paid fairly? Are they happy in their jobs? Do they feel like they can do the best possible work? Yeah.
Yeah, I think from at least the Nasdaq perspective, a lot of the integration piece comes down to something that was spoken to in the fireside chat, which is understand what your material topics are and then go forth and conquer. So to Claire's point, if you're thinking about your business as a consumer goods, there are a few considerations that she called out, but changes business to business. So I think first step is always understanding the material items to your business and then making decisions from there. The next question I have, question for Robert, which I find very interesting. What are some common legal ESG items that startups don't think about and should be in the beginning versus during the growth or at the investor stage?
Yeah. So I think that on the legal side, like I said, like the governance is something that's really easy to implement right away. And just, do you have a board? Like, are you holding meetings? Are you keeping a track record of what's going on? Because that is something that is fundamental to the business and is going to be really important for anybody who is thinking about investing in the company. Kind of the environmental side, I think that there's less legal kind of things to think about. And it really comes down to on the governance and the social side, which can be things like data protection. And so, protecting the data that you're collecting, and then on, fostering a diverse set of stakeholders. So not just board members, but are you talking to customers in different segments? Like all of those can kind of can protect the company and can show a strong ESG program, even at a really, really early stage. So yeah, and I mean, I think and that's something that like on the legal side, like that's something your attorneys can and should be helping you, because it helps you put on a good face for investors. And so like our value add is not in filling out forms, like incorporating you, like, right, like filing a certificate of incorporation in Delaware. It's like really coaching you on how to like present well for an investor and show maturity as a governing body.
Definitely. Next question, just generally to the panel. Who's the person at the enterprise level who's making decisions about which ESG programs or initiatives to invest in?
Yeah, this is one I thought was covered in the fireside well. Like I think he said, it needs to hang reasonably high in an organization broadly. I think that's right. I started as a data person, and I've seen a bunch of orgs try and integrate. Oh, we're now going to care about data and analytics, and we're going to hire some junior person and bolt them on. And I would often say, like, there's this concept of organ rejection, almost like the enterprise just isn't built to support it, and like it just kind of dies on the vine. I think some of this is similar if it doesn't have the support of and the integration through the organization. It makes it really hard to thrive. So like this, it needs to be somebody really senior. I agree. It doesn't need to be the CEO that are kind of making these calls. Oftentimes that may not even be the right answer to kind of make some of these calls, but like to do this well, these kind of decisions and support structures and infrastructure and things like that needs to be intertwined in the DNA, which means it needs to have the support up the chain.
Claire, question for you, just kind of on that human capital strategy topic that we were talking through a little bit ago. How might someone without a sustainability or ESG background contribute to helping companies incorporate ESG philosophy or DNA in that company?
I'm interpreting this to mean like someone, maybe not a founder at an early stage company who cares about this, but is trying to figure out how they can do some of this. It's tricky, especially if your founder team doesn't care, can't make time for it. It's really hard. Yeah, so I'll just kind of put that out there. I think you can try to make the case, but like the hierarchy, especially in early stage companies, I mean, in any companies, but in early stage companies is really hard. Like by and large, what the founder says goes. So if they're not on board, it's really tough. There's probably a little bit of like stealth stuff you can do depending on your role, right? If you're in sales or in product or recruitment, like there's bits that you can probably insert as a part of doing your job well. But company-wide, even if your company is 6 people, initiatives like need the founders to be on board. That said, I was in essentially that position not that long ago, and particularly thinking about DEI within early stage companies, which by and large don't have in-house HR or talent for a long time. And a bunch of us, I think a group of like 30 or 40 people under the umbrella of an organization kind of hosted by the KPMG Foundation, found each other and would get together once a month and honestly like commiserate and try to give each other some advice and think about what we could do within our companies as data scientists or product people or engineers to bring in a little bit of DEI thinking. And a colleague and I tried to capture that and like documented it. So we wrote these 5 chapters on Medium. I'm happy to drop the links in here. So on the DEI side, we tried to put together something really practical on what you can do as an employee in an early stage company when you're not the founder, to like bring some of that in. And sometimes the founder may not be uninterested, but doesn't have the capacity. So if you can start to build it up and make the case and show that other employees really are interested or candidates are interested, then they may decide to kind of take it on and give you a little bit more cover. But it can be a little fraught.
Yeah, acknowledging from the skill set perspective specifically, my background's in industrial engineering, not anything specific to ESG. I think when you think about having an impact on the ESG matters within an organization, it reaches much farther than you might think, right? So industrial engineering, don't know how that incorporates into ESG. You can think about efficiency matters, making things efficient from a climate perspective, using less energy, et cetera. So I'd encourage whomever kind of posed that question to think through what their capabilities are and then match them up really to some of those ESG topics, because I think there's more likely than not a pathway towards that skill set already being there, and you just need to articulate it. Last question here, and Jeff, I'll punt this over to you, just acknowledging your very lengthy board experience. What's the best way to get on corporate boards that care about ESG, that align with my ethics and social interests?
It's a good question. I think most boards, so certainly kind of early stage startup through kind of mid to late stage, will have various kind of what they call independent board members that aren't representative of either the management team or the group of investors that are seated to bring a certain focus. inside of an organization. That may be, a direct-to-consumer focus, somebody who's done that maybe I want somebody to do intros. Or, it might be somebody we realize that this is important. We need somebody at a board level that's going to kind of own this. And, we need to bring in somebody that's going to help there. That's what you're looking for in terms of board construct, where, they need somebody. It's an organization that's realized this is something that's important to them, and they want to bring in somebody at a board level that's going to be the champion, that they view that as a gap for them at the board level. So that's kind of what you're looking for. Then, okay, how do you find that? I think oftentimes when boards are searching for those things, they go through networks and things like that. So be out there networking, all the things that I mentioned before, like, build a network of investors, build a network of entrepreneurs, put it out there that this is something you're looking to do, because somebody is going to be in one of those conversations and saying, hey, we should bring in a board member who's thinking about this. And that person you may have met at a conference a month ago saying, aha, I know somebody who would be perfect for that, right? Like, you want to be in the middle of those conversations as best you can, but like, that's kind of the situation you want to find.
Appreciate that detail. Just for our last questions posed to myself, selfishly, I will be taking it. Question was, what are the top 3 things you suggest for a startup to consider in implementing ESG in the beginning of their business phase? So I think first, we talked about this a little bit, is understanding material topics. And I don't mean that in a financial materiality perspective, more so what is material to Claire's point, the founder's intentions and strategic vision. How do we map some of those things to some of the outcomes that we're looking to achieve? So that's one. Once you have that materiality done, taking a look at what the current state of the business looks like up against some of those materiality topics. So are you succeeding in some places? Are you lagging behind in other places? Where is your low-hanging fruit? And then the last piece I would look at is, what are some of the peers in my industry or some of my like C-suite peers or other founders thinking about and doing, and making sure you're either at parity for some of the material items that you've identified, or outperforming, etc. So I'd like to thank Robert, Claire, Jeff for the engaging conversation. I think a lot of great insights, a lot of good common themes that we uncovered throughout this conversation. And I'll go ahead and pass it back over to Colin.
Awesome. Thank you, Lisa, Claire, Robert, Jeff. Thank you so much.
Yeah,
Thanks,
thanks, Lisa.
Bootcamp.
Thanks for moderating, by the way.
Yeah.
Very
Amazing.
well done.
This is a boot camp, but that panel really felt like a boot camp. You guys really just packed so much great stuff into there. So thank you so much for the time. We really appreciate having you.
Thanks, Colin.
All righty, folks. Well, we're going to now take a quick short break before jumping into our next session on how later stage winners are looking at ESG and pre-IPO ESG implications. So fill up those coffee cups and you will see you in a moment. All righty, welcome back to our next panel on how later stage winners are looking at ESG and pre-IPO ESG implications. Quick note, we're going to open up for live Q&A near the end of this panel, so please continue to submit those questions for us in the Q&A function at the bottom of your screen throughout the presentation. Now, without any further delay, please join me in giving a warm welcome in the chat to our special guests. We've got our moderator, Roberta Burrows, who is a board member at the Nasdaq Entrepreneurial Center, Steve Vargas, who's a head of ESG advisory at Nasdaq. Welcoming back from our fireside chat this morning, we've got Amanda Urquiza, who's a partner at Wilson Sonsini. We're welcoming back to the ESG Bootcamp, Ella Eskenazi, who's a head of sustainable finance and climate at BMO Commercial Bank, and Stephen Brown, who is a senior advisor at KPMG. Team, so glad to see you. Roberta, over to you.
Thank you, Colin. I'm so happy to be here. So I'm Roberta Burrows. As mentioned, I'm a board member here at the Nasdaq Entrepreneurial Center. Before we get started and into the deep conversation, I would love for our panelists to introduce themselves as Colin introduced you in that order. So I'm going to start with you, Steve Vargas, head of ESG advisory at Nasdaq.
Wonderful. Well, thank you so much for having me today. Excited for today's conversation. My name is Steve Vargas. I lead Nasdaq's ESG advisory practice. So what that means is on a day-to-day basis, we work very closely with pre-IPO as well as post-IPO companies on ESG and climate strategy development, geared and oriented for a capital markets audience. So I would say we're quite busy with all things ESG here at the exchange, but have the incredible fortune to work with some really bright individuals that I'm proud to call colleagues, and looking forward to sharing some key tidbits and insights along the way.
Thank you, Steve. Amanda.
Sure. I'm Amanda Urquiza. I am a corporate and securities partner at Wilson Sonsini. I focus my practice on late stage private and public companies, and I also head our sustainability and ESG advisory practice at the firm, which includes over a dozen practice areas that support our clients in all aspects of sustainability and ESG. And I am excited to be here today with this group.
Thank you, Amanda. Ella.
Thank you, Roberta. Hi, everyone. My name is Ela Eskenazi. I am head of sustainable finance and clean energy at BMO Commercial Bank, and we're one of the leading North American bank, huge presence, both on the commercial side, but also on the consumer side in US, Canada. So I'm responsible for obviously working with all the key partner and solutions to mobilize engagement on sustainable finance, how we can help companies achieve their sustainability journey, investing in the necessary technology or decarbonization kind of opportunities. But also on the other hand, we're also pursuing clean energy companies so that they can grow, reach scale by many of the financing vehicles we have or banking solutions we have in our hands. So thank you. I look forward to being part of this call.
Thank you so much. And Stephen, that's right, people. We have Steve and we have Stephen. Remember that. Okay. Stephen.
Sorry, I was on mute. I was saying thank you so much for setting that out, because we do have two Steves, and you've solved it by calling me Stephen and calling Mr. Vargas Steve. So thank you so much. I'm Stephen Brown. I'm a managing director and senior advisor at the KPMG Board Leadership Center, where we spend just about all of our time working for our client boards and C-suites on a number of ESG and corporate governance issues. I'm a corporate securities lawyer by trade from a long time ago, and led a corporate governance group at a very large asset manager, and sit on a number of boards in the nonprofit sector, including the NFL Alumni Board. And so I'm so happy to be with you guys. And again, thank you, Roberta, for clearing that little minor thing up about the two Steves.
Absolutely. You know, it's all in the details. So without any ado, let's get started and jump into this conversation. I'm going to start with you, Steve. You work with a lot of companies on establishing climate strategies. So for our audience, what advice would you give to pre-IPO companies in navigating the related regulatory environment today?
Yeah, and I could appreciate we've got a lot of entrepreneurs, a lot of pre-IPO companies in attendance and dialing in today. So, you know, with that backdrop, first area of, I would say, opportunity is just acknowledging that it's important to start early, well in advance of an IPO, because of the time required for, you know, data collection, strategy development, but, you know, really importantly, stakeholder engagement. You know, also important to acknowledge that some of these, you know, skill sets take time to build internal expertise or experience around, particularly on a subject matter that may be quite different, right, than how you've evolved as an organization or as an individual. So really making sure that you're, I would say, allocating the necessary maybe time and headspace to, you know, train staff, or in other instances, maybe leveraging, you know, specialty support from, you know, GPs that are familiar with your story, familiar with your business model, as they likely are also soliciting and hearing feedback from, you know, other companies that they're advising on how to really stand up a sustainability and climate strategy. And then, you know, as it relates to competitive analysis, right, there's also an opportunity for, you know, earlier stage companies to kind of think through how some of your peers are kind of navigating the disclosure landscape, right? And there's a lot of really, really good information that's out in the public right now. So just being able to, I'd say, benchmark how some of your competitors are evolving their strategy is another way to think through that. And then, last but not least, from a strategy standpoint, I wouldn't conflate disclosure as a substitute for strategy. It's typically, the end result of a pre-existing effort or initiative behind the organization. So this is where you just, I would say, need to be really mindful of greenwashing, especially as regulators are cracking down on, claims that may be, tough to substantiate, right, to external audiences. So quite a bit to lead us off there. But maybe before kicking it back to you, Roberta, just kind of reflecting on maybe ways in which startups can kind of think through how their ESG efforts, right, comply with evolving regulations or stakeholder demands. Important to just kind of back up a little bit and just acknowledge that ESG by definition is a pretty broad to multi-stakeholder value creation exercise. So to be efficient and effective in building that program, there needs to be a balance, right, on consistent effort over time, but also being able to adapt and being flexible on just the, I would say, emerging regulation that we continue to see here, not only in the States, but out in Europe. And one way that startups can kind of think, through that opportunity is, looking at their existing ESG efforts and then thinking about maybe a grid matrix exercise, kind of overlapping some of the disclosure frameworks or regulatory frameworks like, the SEC, California Climate Bill, CSRD, ISSB, and just kind of see where there's maybe pre-existing data that you can start making progress on, or at least to identify gaps, right, where maybe efforts don't currently exist. And that's obviously an area where, startups and, pre-IPO companies can, spend, a decent amount of their time and attention.
Thank you, Stephen. You actually answered the second tier of my question already. So, which was how companies, particularly startups, could ensure that their ESG efforts were complying with those evolving regulations. And you answered that just now. So appreciate that. But let's double click on some of the things you were talking about tertiarily around the SEC climate disclosure rule, et cetera. And Amanda, I know, have there been any regulatory shifts in ESGs that companies should be aware of? Can you describe the new SEC climate disclosure rules for our audience? And what implications do they have for the pre-IPO company?
Absolutely. Thanks, Roberta. So we absolutely have seen a meaningful regulatory shift in the ESG landscape, even in just the last 6 months. So 2024 is the reporting period for the very first tranche of entities that fall within scope of the EU's Corporate Sustainability Reporting Directive, or CSRD. So we're seeing companies gear up to report on that for their fiscal years that started 2024. There'll be other additional tranches for companies that fall within scope in later years, but this is, the first year for the companies that are already within scope. In March of this year, as you mentioned, the SEC adopted its anticipated climate disclosure rules and subsequently stayed their own rules after several challenges were brought in different federal circuit courts and consolidated in the 8th Circuit of Appeals. And just to give you a quick double click on the substance of the final SEC climate disclosure rules, they were scaled back substantially from the proposed rules that we saw in 2022 and included 3 buckets of disclosures. So essentially the same 3 buckets that we saw in the proposed rules, but scaled back a bit. The first is ESG risk and governance disclosure, so kind of in line with what we typically see for public companies that report on risks and governance processes and procedures. Companies will need to do that with respect to ESG, and all of these requirements were materiality qualified. The second bucket was scope 1 and 2 emissions reporting and assurance with respect to those emissions disclosures. Those were also materiality qualified and only apply to larger issuers. And And then the third bucket of disclosures that we saw in the final SEC rules were financial statement disclosures for severe weather events and certain expenses related to offsets and RECs. And those were also materiality qualified. And so we really saw sort of a trend here with a lot of materiality qualification, which we think was probably intentional on the part of the SEC with the hope of getting these rules through the gate in light of all the various legal challenges that the SEC could probably foresee. The SEC also has a couple of ESG related rulemaking items on their regulatory agenda, including corporate board diversity disclosure and another group of human capital management disclosures. So we anticipate seeing those in the near future as well. As Stephen referenced earlier, we also saw state level rules coming out of California. Those were very interesting and unprecedented. Those have faced some legal challenges and some budgetary challenges. And so we're looking to see with a couple of those how they'll do as the implementing regulations are expected by the end of this year. So at a high level, we're really seeing ESG regulations advance, but we're also seeing some headwinds as well, particularly in the United States and specifically in our current political climate. On the question of what IPO companies can do now, there are a few thoughts that I have on that front. I think a good starting place is education. So, ensuring that your internal functions, your management, your board all have the appropriate level of education for your organization and are aware of what exists in the ESG landscape and what the requirements are that are coming down the pipeline. I think companies should be conducting a scope assessment, so ensuring that they know which requirements they fall within scope of. We're all on standby on what will happen with the final SEC rules, but it certainly doesn't hurt to conduct a scope assessment and then map the requirements against one another. And there, my firm put out a comparative tool to do that. Other firms have those other third parties provide them. So, familiarizing yourself with the resources for conducting that scope assessment and mapping can be really helpful. As Steve mentioned, you can do some benchmarking. You can do benchmarking against, companies that have been voluntarily reporting what is required under various frameworks. As many of you know, the SEC rules fundamentally came from the TCFD framework. And so there are many public companies that have been reporting under TCFD that you can take a look at and assess what those disclosures look like. Absolutely begin liaising with third parties. So if you believe under various frameworks you'll have to report emissions, you can start looking for a carbon accounting firm to help with that work, assessing internal capacities and capabilities within your organization. And then, planning integration into existing systems. So how will you feed this into your controls environment, your quarter close procedures, your disclosure committee, your enterprise risk management? So starting to think of it sort of systemically. And then just sort of one quick thought before I pass the mic back to Roberta on regulations on the horizon that you might want to keep top of mind. I think, we know that there will be phase-in periods under CSRD, so be aware of those. We know that the SEC climate rules, ultimately find out whether a portion or all of them will stand. But one area that I do want to flag is ISSB. Those are voluntary. That's a voluntary reporting framework, but we are seeing several jurisdictions adopt regulations that are aligned with ISSB. So it's a good idea to be aware of the jurisdictions where that is happening and determine whether your organization operates within those jurisdictions and keep attuned with that evolving landscape.
Thank you so much, Amanda, and appreciate you adding on to the additional regulations on the horizon that people should keep in mind. as well as double clicking in on the climate disclosure rule. That's really, really informative and helpful. So we're going to shift a bit and actually ask Stephen a question around corporate governance. You work a lot on corporate governance, and have you seen in your work an increase in the ESG conversations in the boardroom? And if so, what do you see these conversations focusing on today?
Well, indeed, boards, I think all boards are fully aware of the term ESG now that that term is entering its 20th anniversary of existence. Although not all boards or folks who are sitting on boards may be clear on what that term exactly means to them. And in that sentence, means to them is the key phrase there. Leading boards, I find, or defining what ESG means to them, those material issues that affect their long-term value. And those boards who do that, those directors who do that, have a much easier time in understanding what they need to focus on. Much of what's happening, in the space of just building a company, in the space of running a company, is that what senior management and boards must do is prioritize and figure out what do they have to focus on. And with the different jurisdictions that are out there, including the U.S. jurisdiction and the laws that you're seeing popping up in several states, the laws that are coming out of our federal government, the laws that are coming out of Nasdaq in terms of what they need to comply with, it can be confusing. It's not confusing to those who really focus on what's material and what it means to them. And so I think one of the first things about being a leader here, a leader meaning that you are appropriately assessing your priorities, is defining that term for you. And by breaking it down for the enterprise, both for the short and long term. And one of those ways that I would stress is that you got to reject the othering. The idea that there's running the company and then there's the ESG stuff. And the best way to define it is, first of all, break it out from environmental, social issues, and governance issues, and develop a unambiguous, connected theme to running your business. And companies who do that, and boards who do that, really do well. And they're able to figure out, separate the noise from what matters. Because there is a lot of noise. And I use noise, if I can use that term, not in a pejorative way, but the idea that there's a lot coming at you, particularly if you're building a company, particularly if you're pre-IPO, and you're trying to get ready to go into avail yourselves of the capital markets. There's a lot coming at you. And you really want to define what really matters to you, particularly during this period if you're a U.S. company, where you don't have, for climate, for instance, you don't have a climate rule yet in the United States. It's been stayed, as we already heard. But if you're a global company, you're going to have to comply with what's happening in those jurisdictions, including, if you're doing business in California, while that rule still has viability right now. So I think it's deeply important to really have a good definition on what environmental, social, and governance issues really matter to you as a company, because it matters. And the last thing I'll say here is that, particularly if you're not public yet, because even if we have a climate rule, if we get a human capital management rule out of the SEC, and some of the other rules that they're thinking of that's on their agenda, it would not apply to you directly. But remember, if you're supplying someone who's a public company, if I'm a public company in procurement, I'm asking you, supplier, private company, to provide that information to me. So under the rules, where scope 1, scope 2, scope 3, which we may have been discussed earlier before this panel, your scope 3 for a company is someone else's scope 1 and scope 2. And so I'm going to ask you to give me that information, and you're going to give it to me for free. And if you can't, I'm going to move on to another vendor. So this is one of the ways where in the different jurisdictions, these rules, even if they don't apply to you directly, somehow you can get swept up, because from a business standpoint, data is king to disclosure. And I tell companies, you should look to your suppliers to give you that data. They're the ones who have it. They may not have put it together. They may not want to put it together. They may not have to put it together from a regulatory standpoint, but you may have the power to force them to do that. It will make your job easier.
Thank you so much, Stephen. That was an excellent point, too, in terms of even if you're not publicly traded yet, how you still have a responsibility if you're working with a publicly traded customer per se. So thank you for that. And also to your point about connectedness, let's talk a little bit about tax benefits with you, Ella. Are there any tax benefits or incentives available to companies implementing ESG initiatives? For example, clean energy taxes, tax deductions for sustainable practices, et cetera. Could you talk a little bit about that?
Yes, definitely. There are awesome incentives driven by a few recent legislations. IRA, I believe most of the US folks have heard about, but also CHIPS and Science Act. It's, in the US, we talk a lot about decarbonization as a country. There is expectation of reduction of carbon emissions in the US, 50% by 2030. So as you alluded, companies have now these tax incentives, expanded tax incentives. We have had tax incentives before, but they are much more expanded. A lot more different type of entities are now eligible to take advantage of it. If I am to give some examples, it's definitely on the clean energy side, clean electricity, like, we want to replace fossil fuels. So there, over the next 10 years, solar PV, battery storage, right? So there companies can take advantage of about 30% tax rate, maybe even higher, depending on the location and some of the other additional incentives, adders. It's important because these are the things the companies can take advantage when they are contemplating working on their ESG strategy, right? It's beyond reporting. What is the company's impact? What the company's focused on, are moving from fossil fuels to using clean energy, how they are displaying that electrification, because that also translates into the, some of the new products and solutions that they bring to market, being low carbon or zero carbon. Likewise, if any participants out here related to manufacturing or somehow associated with clean energy manufacturing, there are incentives to onshore some of these technology critical components. Again, it is actually spurred a lot of investment in the US. About 85 to 100 different new investments have been announced since the last 2 years. There's building energy, right? There's also building energy tax credits in place for small, clean, like standalone energy generation or energy efficiency, and also there are some state-driven tax incentives as well. Also, a federal government provides some grants as well. Grants, loan programs are in place. Transportation is another one. Again, companies who are owning, operating big fleets, there are now, commercial EV credits beyond the passenger or personal EV credits that maybe most of us are familiar with. So if you think about it, tax relief is definitely improves the economic viability of a technology, right? Improve cash flow. So, the things are easier to procure and put in place and get the, additional benefits, environmental impact, but also longer term, these investments provide also a lot more cost reduction on the operational expenses side, right? So we are highly encouraging all our clients, private, public, nonprofit, whatever, all be aware of these incentives and take advantage of them.
Thank you so much, Ella. Particularly around, what's in it for these companies, and kind of piggybacking off of that, Steve, you work with a lot of pre-IPO companies on ESG. So obviously Ella talked about a lot of the tax benefits, et cetera, but why should a company get started earlier? And what are some of the KPIs that can demonstrate value to investors? And then secondly, how are later stage winners effectively balancing that ESG risk with ESG opportunity?
Yeah, thanks, Roberta. I mean, a lot to work through there, but really good question. I would say to start with, well, there's a few reasons, but to start with, focusing on ESG sooner than later helps demonstrate focus. not just for you as an organization, but to other stakeholders that are, collaborating or working with you. And ways in which, some of the companies that we're working with pre-IPO, from a focus standpoint, the way that they're doing that is through, conducting a materiality assessment or exercise. And so whether it's engaging with, customers, suppliers, investors, employees, or the board, again, it defines focus on why you as an organization are focusing on specific topics more often than perhaps, other topics that you're spending a little bit less time on. And it also helps the leadership team, right? And employees allocate their time effectively. We have to remember that when we are asking for information and for data, what we're really asking for is for people's time. And so you want to make sure that you're allocating, your collective organizational time in an efficient, manner, and materiality kind of helps some of those pre-IPO, but also, post-IPO companies, through that value creation exercise. I'd also say, it helps organizations define and set the goalposts for what matters most when you're thinking about creating value, right, for your stakeholders. And we've worked with hundreds of companies over the years here on ESG. One observation that I've had as I've kind of sit in my seat is ESG as a discipline sometimes moves within an organization. So what you also want to be mindful of is, are you creating the right governance structures, the right ESG ownership models, so that ESG is sustainable, even if there's an individual that perhaps rotates out of the organization, right? You don't want to strand that knowledge and that expertise in one or two individuals. You want to make sure that that is a discipline that is, again, owned and shared by, distinct elements of the organization that, find it to be an important part, right, of their, day-to-day and just longer-term objectives. I would say, that's another important, aspect, to this. You can't really silo it in a specific individual. Around KPIs, I'll just say that, in our experience, it tends to be pretty specific to the industry or sector in which, a company is competing for capital in, whether that's human capital or, growth capital. And so you want to make sure that, through the lens of materiality, you're kind of defining what those key areas of value creation are. But, I think we can all agree that there's probably a few example KPIs that help demonstrate value specifically to, investor audience. And, from a differentiation standpoint, we got to remember that companies are made of people, and you want the best people, right? Bringing value into the organization and demonstrating how you are attracting and then retaining high quality talent, maybe through the lens of employee engagement, where satisfaction scores is one, KPI that, we found investors to find, particularly relevant, especially in, I would say, asset-light businesses where IT is really tied to, a lot of the value that individuals, right, employees bring to the organization. Second KPI, or an example KPI, I would say is helpful, is, through the lens of climate. And so there's different ways in which you can kind of define, climate impact. But given the movement that we see from regulators, from rating agencies, right, those are data sets that investors prioritize in their, asset allocation decisions. It's typically the emissions data. And even if, I would say, a company has a low, emissions profile, it's important to at least acknowledge, right, how their profile has impact on, an investor's potential overall, portfolio. And it just creates, I would say, a valuable, dialogue, right, between the investor audience and leadership teams, as you kind of describe, what is the strategy behind your overall, climate impact. So I would say from the social side, employee engagement, on the environmental side, kind of given regulatory, influences, usually emissions is a good way to think about it. But as companies think about maybe differentiating themselves from other maybe competitors or peers in the space, one strategy that we've seen, let's say maybe what some winners are embracing or kind of doing some work around, is taking a look at what their competitors are doing, but also what their customers are asking for. So in terms of differentiation, what some more proactive companies are doing, they're reaching out to their customers, they're reaching out to the suppliers, they're asking them the questions that help drive value for their organization. So this is typically done through a lot of the materiality work, but if there's a better understanding and appreciation, right, on how to service those customer ESG needs, there's a lot of relevance, right, in that path to profitability narrative that's really become important in today's IPO landscape. And we heard from Stephen just a few minutes ago. One organization's scope 1, scope 2 is another scope 3, or vice versa. So you definitely want to be, I would say, mindful of where you sit in the overall value chain, and having that proactivity, being able to establish that that impactful dialogue with your customers and suppliers is one way in which we've seen some, I would say, winners kind of separate from the pack a little bit, because they're thinking about ESG again through the lens of what are your customers asking for, how does that have downward impacts on cash flow, margin profile, ability to retain some important customer relationships, or at least develop maybe future customer relationships that you're really trying to advance. So I'll leave it there. I'm sure we'll chat a little bit more about the subject though.
Thank you for that, Steve. Particularly the balance of looking at your competition, but also looking at what your customers are doing. Sometimes organizations look at one or the other with more priority, but utilizing that balance as a way to propel ESG within your organization, I think is a good point. So thank you for that. Digging in deeper, Amanda, Steve talked about some of the KPIs, but what are some metrics and reports that are most important to investors when they're looking to assess a startup's ESG performance?
Yeah, that's such a great question. And unfortunately, I actually don't think there is a one-size-fits-all approach for startups. Different early stage organizations, will have very different risks and opportunities related to ESG and sustainability. And perhaps most importantly, we'll have different levels of resources and functional capacity to make these assessments and push out data. This is also true, I think, of more mature organizations as well, but organizations grow and have different resources and capacity. So collecting data and reporting metrics and framework often, becomes more tenable to do in a standardized way as organizations grow and have higher quality of information and systems to support it. And then I think there's a greater value at that stage too, because then you can, as several folks on here have noted, compare to peer companies. I often see investors in my practice, entering into side letters or including covenants in financing documents related to ESG reporting and compliance that have specific metrics or specific reports cited. And that can be helpful if an organization is capable of providing that. But for many earlier stage organizations, it doesn't always incentivize internal processes and procedures to shore up really good data, or to inform an ESG strategy or properly build ESG into an organization's business strategy. So I often see that investors go further by pushing, startups to think critically about the ways that their business is impacted by ESG or sustainability, and then integrate those risks and opportunities into their organization's larger business plan and operational systems, so that it's part of the way that the business thinks and operates as it scales. And I think, echoing what Steve said a bit earlier, I really do think a materiality assessment can help, focus and suss out for an organization where the risks and opportunities related to ESG are for them. And then anchoring again in good governance is key, so that you have that in place as the organization grows. I do think that various metrics around people and climate are often the first that I see. So, all the things around human capital management, as well as the emissions and carbon accounting, I think for startup companies are often the right place to start. But I think as organizations, and it really does depend on how large they are and sort of where they are in their development, as they focus their resources and efforts, they might prioritize certain things first. And I don't think that's a bad thing. And I think, many investors appreciate sort of seeing what's important to an organization. And so this might mean that a younger tech company conducts a pay equity audit before they do their carbon assessment, because they value diversity and equity and inclusion in their business and see the risk of not having a diverse employee base or the opportunities associated with having a diverse employee base. And they don't necessarily run a carbon intensive business or have meaningful climate related risks right now as the business is currently run. I think having the right systems in place to continue assessing that and make sure that companies are doing the right thing at the right time and reporting out on the right metrics that really reflect where they are with their business, it is important. But I do think for resource limited startups, investors do well at tuning to the types of realities that companies face, and also just sort of zeroing in on where the risks and opportunities are for startups.
Thank you, Amanda. That was really insightful, particularly those examples of how people can do things so that they're not, the values that they have within their companies align with actual things that they're implementing from an ESG perspective. So appreciate that insight and kind of having a conversation that's very similar to that. Stephen, not Steve, Stephen, how can companies ensure that those initiatives, some of those specifics that Amanda was talking about, but those initiatives are genuine and avoid potential greenwashing accusations? Steve talked a little bit about that in his initial conversation.
Listen, Roberta, the simple answer is don't do that. The greenwashing. The simple answer really is don't promise or get close to making a statement that could be interpreted as a promise things that you can't do or you're unwilling to do. And this is something which, as a buyer, a citizen, and also as a corporate securities lawyer, it's quite unforgivable. And this is something for pre-IPO companies who are at that stage. Having discipline around communications is an attribute that you must have, corporate-wide. You got to have the discipline around what you say. It's because saying the wrong thing is bad from a regulatory compliance standpoint. It is bad from a potential customer and reputational issue. So you got to build those internal controls around what you say, why you're saying it, right? And so let me get to the why you're saying it. And I deal a lot in the last few years, during COVID, post-COVID, the things that are happening now in the national conversation in 2024 with elections coming up all around the world, right? In the geopolitics situation. What you say, how you say it, should you say anything else is sort of a big issue inside the boardroom. And so one of the first things is be careful what you say, and whatever you say, mean it. Because different stakeholders will come back to you about what you said, and they'll come back verbatim and repeat to you what you've said, or show you an advertisement, or show you something that you've said, or a clip, and hold you to it. By the way, the SEC will do that too. When you become a public company, that's their job, in terms of disclosure, that you're doing what you say that you do, and that you're actually in compliance. So develop that discipline around what you say. Really sticking with things that are material, that matter to your business, and really thinking deeply about those is important. So for instance, I guess the S part of ESG, the human capital part, having an optimal people strategy makes sense. And it is the thing, again, when you become public, that shareholders in a public company are deeply focused on, and they're deeply focused on your talent issue and human capital management, which is why it's on the Reg Flex agenda to create a human capital rule and have more disclosure here, because shareholders have asked for it, and shareholders have asked for it because the bulk of the valuation of most companies today, 2024 compared to, let's say, 1960, it's not the hard assets, your buildings and other capital, hard capital. It's the soft capital. It's the intangibles. much of which has to do with employees. And by the way, just about everyone says employees are my greatest asset. Everyone says that. You can find it on page 27, on page 10, on page 270 of proxies. Everyone says that. Well, and shareholders are holding you to that and following up. That said, having an optimal people strategy makes sense. So the different issues around those, and again, you mentioned, and Amanda mentioned, a materiality study sort of helps developing what in that category is really material to you, so you understand that, but really developing that discipline around what you say to the public and what you say to a very important constituency are your own employees. Because what we've seen in the last few years, and I've been fascinated as an older person in this space, or I should say a more seasoned person in this space, is the rise of the quote unquote activism with a small a of employees inside their own company. So employees are holding management to what they've said in the past. Employees are holding management to building an environment where they want to be in. So that's deeply important. So focus on what really matters to you and create that discipline around communications, communications to your shareholders, communications to your regulators, of course, and communications to the people who work for you.
Thank you, Stephen. Thank you very much. And just for the panel and for the audience too, Ellen, I'm going to ask you one last individual question. Then we're going to go to 2 group questions for the panel, and then we're going to open it up for our audience just in terms of timing. So Ella, what are some insights that you can share about the role of emerging technology in enhancing ESG performance and financial outcome in the pre-IPO phase? We talked about human capital a lot, but let's talk about some of these emerging technologies here.
Yep, I think I thought about what's the best way to cover this emerging technology and the ESG impact. I think I'm going to go ahead with 2 areas of focus. I think companies can think about. Obviously, we talked a lot about having the strategy leading into focus areas for the companies, measurability around focus areas, KPIs, targets, what have you, and that all the way getting into outside world with some disclosure. So there are definitely reporting and disclosure related technologies out there. The use of AI, I think machine learning, cloud-based ESG reporting solutions, cloud-based carbon accounting platform, right? So these are all, I think, the efficiency, software, centralization capabilities out there for the companies to use, because we talk about traceability, being able to assure these outcomes, being able to audit or audit ready, right? Kind of metrics. So definitely these are the companies can use, and there's a plethora of companies providing these solutions. And I can see a near future where, as we get more kind of dynamic reporting around these, as you know, the companies generate activities, maybe incur a transaction, it comes with the associated, right, carbon emission, So think about, I think the industry will evolve into that way, connecting different systems in the organizations to be able to also report out the resulting impact of something. Okay, so that was reporting disclosure. And most of the companies have started adopting this area very well. I think there's a good uptick in this type of software solutions. The other area I think which is key is operational side. So remember I talked about there's a huge focus on using less energy efficiency, conservation, us being able to move to renewables. So there are other applications, software, because ESG is always about data. Like you do use the data to do better, to waste less, or to be more efficient in your operation. So when we talk about energy use, conservation, some sort of demand, you're managing a demand, right? With maybe pooled resources, use of labor, right? There are these applications, like when we are talking about EVs, especially because they are connected devices, EV fleet management applications, maybe charging infrastructure, right? Like how the chargers are deployed, where they are deployed, the connectivity, and even we're talking about the chargers being connected to grid, EVs connected to grid to go back. So there are a lot of things because enabled by connectivity, Internet of Things, 5G. So those are all the things that companies can use in terms of thinking about the long-term strategy. The other examples is like food companies and agriculture, especially. There are a lot of improved geospatial data, right? Satellite data use. Think about it, how that is transforming the way certain practices are managed. The sensors, right? Sensors are important, collecting data, being able to connect and deploy a source of input, right, which is more optimized. So again, it's eliminating waste, but also it results in cost, because everything that you do to reduce your waste to get efficiency in place will ultimately result in financial expense controls or reduction. So anyways, there are so many things. I think the operational examples are for the different industries that I try to do a little bit deep dive, but it is out there and it is a fast evolving field.
Thank you so much, Ella. And Ella, I'm going to stay with you too, because we're going to do a firing round right now, like in a minute or so. What's one piece of advice you would want to leave the attendees with today?
I think some of our speakers alluded to this. It's an exciting time. If you're talking about an IPO, it's a major event, major financing event, a lot of driven by finance, CFO. So, but the ESG focus should start well ahead of the timing, right? Lots of things go in. It's crunch time. So when you are thinking about establishing strategy, expanding in the market, think about, are your solutions bringing impact in low carbon, being us, helping us, the economy, the industry, your clients being more efficient. Okay. So articulation of that strategy when you're going to market, and how unique it is, how well it is positioned against existing players, peers, is a lot more important. I feel there's going to be a lot more impact of that value proposition that you bring, and the market is expecting this type of change transition.
Thank you. Before we go to questions, Steve, 10 seconds. One last advice.
Right. 10 seconds. All right. ESG is not a slogan, it's a strategy. So if you have trouble tying your ESG efforts to minimizing margin contraction or expanding your margins or how it impacts EBITDA or revenue, we just, I would say encourage folks to kind of think about reevaluating the lens through which you define your ESG strategy. 10 seconds. Hopefully I made the mark there.
Just want to get some questions. And Amanda.
Yes, I'll be quick as well. My advice would be leverage your advisors and friends. Auditors, outside counsel have a ton of publicly available resources and tools that articulate regulatory requirements, compare them to one another. They can be really helpful. You don't have to do this all on your own. And all of that is usually free to you. On the friends piece, I spent some of my own professional time in-house, and one of the greatest resources that I leveraged while in-house was a network of friends at similarly situated companies, because they can share operational insights and practical approaches that sometimes outside counsel and auditors just don't have, because they're not in the same position, don't have the same visibility. So as you navigate your ESG strategy and try to operationalize it, sometimes those folks who are similarly situated can give you the greatest insight because they're doing it too.
Okay. And lastly, Stephen, before we go to audience questions.
The biggest thing that folks can do is really think about who's sitting on their board as they go public. It matters. It matters deeply. It matters to shareholders. It will matter more to them as you move along and that maturity scale of being a public company. But think about what value they bring to the table and what skill sets they have. So think about who's sitting on your board.
Thank you all. So let's go to the audience. I'm going to ask these questions, and then I am also going to leave it to you all to decide who you think is best to answer them. They could cross-pollinate across all of you, or one person could be more useful to answer the question. So first question, which ESG issues do you all think are going to gather traction in the next 20 years? Steve, actually, that's a strategy. I'm going to go to you for that first.
Which ESG issue will have the greatest traction in 20 years? So 2044. So from my vantage point, I'm watching a particular space quite closely, and that's the usage of carbon credits as a part of a company's decarbonization and carbon neutrality strategy, in that there are some businesses that are very hard to decarbonize. Some technology may not exist today that may exist in the future. And the relevance of potentially using carbon credits I see as being an area of increasing impact, increasing influence, knowing that, you know, right now our emissions collectively, right, as a society continue to ratchet up. And there are some carbon negative technologies that are able to leverage carbon credits. So the short, maybe my response here, I'm looking at carbon credits as an area of increased interest and impact 20 years from now, but that's a very long time, and I could be wrong. We'll see. Let's do another call in 20 years and see if I'm right.
20 years is a long time, and I think my response to that, it depends on the actual what industry you are in. But what I think is universal is how you communicate what your strategy is, and that cuts across all industries. And you see right now today that there's a big difference in how people communicate. I could talk about a tobacco company that has a very good communication around what their strategy is related to ESG, and then some new technology, carbon capture, or electric companies who do not have a good strategy, and it matters. So in 10 years and 15 years and 20 years, it's still going to matter now how well you communicate your strategy to your different stakeholders.
Amanda, Ella, you want to jump in on this one?
Yeah, I liked both key teams, but I think I'd like to bet on supply chain engagement. It's as you know, we have to transform the world, right? The South North developed countries versus developing countries. There's a huge impact of the change, the transition that needs to happen in supply chains. So the other companies serving big companies, right? So how I think there's going to be, we can expect increased collaboration, partnership, and in fact, the companies investing directly in their supply chains, working, bringing them up to speed, providing technical guidance. So because that's how it's going to happen. There's a lot of work to be done, but I want to bet, next 5 years we'll find ways of doing these standards, mechanisms, financing instruments. So I hope to see also an uptick in corporate engagement around supply chain.
Another question here, Amanda, I think this one could be one that you could start off. Any thoughts on when considering the impacts of scopes 1 to 4 on practices internally and externally?
So I imagine that's a question about how to think about emission scopes and internal practice. I'm not quite sure how to tackle that because it could be a fairly broad question around the impact of those assessments on internal operations. So I don't know if I'm approaching this in the way that it's intended. I think that not all companies, have the same scope of emissions materiality. So depending on a company's business, they may have material scope 1 emissions and they may not. I have several tech clients that, have very, very low scope 1 emissions. But the bulk of their emissions are, scope 3 emissions. So I think when considering emissions and internal and external impacts or approaches, I think that because each business will be different and you will be thinking about how to lower your carbon footprint based on the emissions profile of your specific organization, I think that the approach is going to be very bespoke. And I think that first figuring, obtaining a carbon accounting firm or leveraging internal resources to conduct an assessment on your emissions and figure out where your greatest, most material emissions exist is a great first step. And then I think the approach that you ultimately take to offset or reduce your emissions based on the scope that they are will very much depend on sort of how you operate your business and where the material impacts are. I don't know if others on this call have other more specific thoughts, but my sense is this is going to be very specific to each organization.
Got it. I'll pass that to you, Steve. I know you probably have some insight on that.
Yeah, I mean, I think to Amanda's point, it'll be industry specific. Fair to say that most organizations, emissions profile will come from their value chain, and that kind of maybe reinforces what Ella was mentioning a little bit earlier, in that engagement is going to continue to be pretty important as it relates to assessing the impact through all different scopes of emissions. But where the greatest, I guess to reuse the term here, where the greatest impact is probably going to be felt is going to be scope 3, right? Just given the complexity of a lot of businesses, and that does require a lot of collaboration, a lot of partnership, a lot of industry, right? Collaboration. So I would say scope 3 is probably going to be where we're going to have to see the greatest amount of activity.
Last question. So wanted to ask this question to everyone. First, Stephen, I will ask you, but how do you see diversity evolving given the current environment?
How do I see diversity evolve given, and I missed the last part?
In the current environment.
Just in the current environment. Well, look, despite some folks in a movement sort of anti-DE, anti-ESG, it's going to exist forever. Why? Because conceptually, globally, it exists and must be dealt with. I think, listen, in the state of California, you actually had a law before it was declared invalid. But while that law was enforced, folks complied. And not only did you see compliance, you had many executives say, well, I probably wouldn't have done this, added a woman or a person of color, because I was going to add, I had 5 other people in mind who were close to me, who were my friends. But wow, I'm glad that I did. And so they sort of caught religion after doing it, and it was a regulatory push that had them do it. But they understand it now, and some of them are evangelists around thinking very broadly around diversity. The bottom line is that where this exists today and where it's going is that your people strategy matters deeply. It matters, particularly that you make widgets, but most people are making their money off of intellectual property and off of the people power, right? So it deeply matters. And so you want to understand how you win at that talent game. And part of winning that is that having a very open mind about finding the best people to do the job and the folks that look like the people who you are selling to, men and women and people of all different colors. So the issue needs to be managed, and it's here to stay.
Thank you. Thank you so much. Anyone else have anything to add to that last question?
I would echo what Stephen said on diversity. I don't think it's going anywhere. And I am always, I'm always inspired by the data that comes out of the, emerging workforce, which is mostly, a millennial workforce that cares deeply about diversity, equity, and inclusion. And so I think as we see our workforce, replaced by a group of individuals that care about these issues and care to work at organizations that care about these issues and reflect them in their values and their operational practices. I can't see any way that companies would want to or be aligned with doing anything other than cultivating diversity at each level within their organization, because I think their customers demand it, their workforce is demanding it. And so I think that we're at an exciting place, even if our rules and regulations are not always up to par in ensuring that organizations reflect the communities that they serve. I do think that we are moving toward a more diverse, equitable, and inclusive work environment across companies.
All right. Well, thank you. I think Colin's going to come back on.
Of
all right.
course,
Thank
Roberta.
you so much, everyone. Colin, let me turn it over to you.
Roberta, thank you so much for leading such a great discussion. And of course, Ella, Amanda, Steve, and Steven, great job. I think we look forward to seeing what's on the horizon. I think 20 years is a long time, but I think many of the things that you shared today throughout this discussion were super valuable for everyone in attendance today. So thank you on behalf of everyone in attendance, and of course from everyone at the Nasdaq Entrepreneurial Center. Really appreciate it.
Thank you.
Also, for those
Thank
of
you.
you still, oh, thanks, Steve. For those of you still on, if you'd like to book a meeting with our partners, check out that poll. You can click there. We also have a bunch of really great programming coming up on the horizon. So check those out in the follow-up email. We've got a bunch of resources that in as well. But from all of us here at the Nasdaq Entrepreneurial Center, we really appreciate you joining us today. Hopefully this was useful, and we look forward to welcoming you all back online soon. Thanks again, everyone.